We're joined live from Amsterdam by Mark Donovan. He is co-CEO at Robeco Investment Management. So good morning, Mark. Tell us what lessons we should have learned then over the last decade.
Well, I think the most important lesson out of that was that the single biggest determinant of the success of an investment is the price you pay for it. And there were just way too many stocks that were grossly overpriced 10 years ago that really had no chance of being good long-term investments just because people were paying so much on day one.
We've had a tremendous global rally on stock markets over the last 12 months. Tell me where you see equity markets going as we enter into this new period of reduced central bank liquidity around the world.
We're finding a pretty good idea flow across the spectrum of the U.S. marketplace. So the area probably of the greatest abundance ideas for us right now is technology, which is a little ironic because as value investors 10 years ago, we were finding virtually nothing in technology. But today, there are a lot of high-quality global players in the tech area that are trading at very sensible multiples. A name like a Hewlett-Packard trades only at about 11.5 times this fiscal year's earnings, and an even lower multiple relative to free cash flow. And that, I think, illustrates one of the most appealing things we see within the tech area. A lot of the big tech names are generating free cash flow levels that are well above their reported earnings levels. So we really think they're hidden values that are plentiful in the group.
How about banks, property insurance? These are some of the sectors that have made the biggest gains over the last 12 months. Is that expected to continue?
Yeah, we like the financials still. I think that's where a little bit of the dry powder we think to the recovery has yet to play out. There are still an awful lot of banks that are earning low single-digit return on equity that we think will normalize over time back towards low to mid-teen return on equity. So names like Wells Fargo, JP Morgan, we think have a very attractive risk-reward, and we think it's well worth playing. But you do have to continually monitor credit trends. That's going to be the big driver of whether they're successful investments or not.
Also on the subject of financials, are you concerned that as governments cut down on their budget deficits, crack down on spending, that default risk is going to transfer back onto the banks in the form of people defaulting on their loans again?
I think government intervention is a threat for everything in the U.S. marketplace. I mean, this is a pretty activist U.S. Government we have in the United States right now. I think there's going to be a lot of pressure to raise taxes through closing corporate loopholes. So, I mean, one thing we look at a lot are companies that have been paying abnormally low tax rates, because I think it's going to be hard to persist going forward, and I think those are companies best avoided right now.
What are some of those companies that you're talking about?
Well, I mean, I'd look at something like a General Electric, which for years has paid a level of taxes far below the statutory tax rate in the U.S. And I just think in light of the budgetary pressures in the U.S. that you alluded to, it's going to be very, very hard for companies to persist with very, very low effective tax rates.
Now, we've seen volumes down. They're down by approximately 15% year to date, here in London at least. So how's that going to impact your strategy?
Volume of
does low
volume
in the markets impact your strategy at all?
It really doesn't. I mean, we're bottom-up stock pickers. We find what we believe to be good businesses and buy them when they're trading at a good price. So technical indicators like volume and whatnot really don't feed a great deal into our selection process.
Mark Donovan, co-CEO of Robeco, their portfolio manager. Thanks so much for joining us.